I am extremely excited to welcome back my guest, Byron Allen. I'm really honored to be hosting you again for a second time on the channel. This is amazing. And today we're going to dive into a little bit more about the mechanics of insurance companies. It's not often that we get to talk to executives from insurance companies and get to share. So I think this is a really unique opportunity for people to kind of see behind the curtain and how, companies actually operate. So I just want to say thank you for taking time. I know as a CEO, you're very, 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 very busy, and to fit me in I appreciate it.
Happy, honored to, Danny. You've been a great financial advisor for representing our company and others as well. But happy to give back and hopefully this is of value to some of your viewers as well.
Well, thank you so much. I'm not partial to any one company. I'm independent. I don't have any favorites, but I am very proud to be an, American Savings agent because I really love the values that you guys have, the leadership, the direction, the vision, getting to really learn about who you are and your culture really is what makes me feel confident as an agent when I get an opportunity to represent you. And you guys have proven over time to be very versatile and not afraid to go out there and compete to try to bring the best of the best to the market and the clients. And I love that about you guys. So let's dive in before we get too far down the rabbit hole there. So a lot of people want to know. You look at an insurance company and you look at a bank, right? You go to a bank and you get maybe like a 4.5%, 5% CD at the time filming this right now, right? You go to an insurance company, particularly your company, right? You have rates that are as high as 5% right now. How can, when they're talking about rates being cut, how can American Savings pay 5% to the client, pay me a commission for selling the annuity, and then you guys still be profitable on that?
Sure. It's really so the insurance business primarily is driven, or its profitability is primarily driven by a spread business. So it's especially for annuity companies where it's just a matter of, can the insurance company earn
Mm-hmm.
more than our capital costs, right? Then the we have to pay out in the liabilities, the benefits of the policies, and and that's the name of the game. So we diversify. We invest in a variety of different investments, and that's just the challenge. And we're able to, with interest rates. Investment rates are certainly higher, and you can leverage that right in a variety of ways. There's I mean that is the reason why there's there's actually been a lot of new companies formed in the last 5 years, as I know
There
you're aware.
has.
And it's because especially in the lower interest rate environment, it made even more sense. But even still now, these private equity groups and these other groups are recognizing that, hey, there's a spread that can be made on these, and they feel they have a niche in investing that they can earn a higher return than others. And so that's
Mm.
just what we have to do, is make that spread. So we have to make sure we're earning enough to pay all those and still be profitable. And fortunately, that's been one of our strengths. That's really a unique thing about our company, is we've been consistently profitable for almost every of the 70 years we've been around. Almost. Few exceptions, and none of
Well,
those exceptions in the last 30 or 40 years.
well, of course, not under current leadership. Come on. You probably
Where's
gave
some
it.
wood to knock on here?
Yeah, right, exactly. Like it was all going fine until the Daniel Ronberg Nation
Right.
interview, and that's so okay. So let me ask you a question that I didn't share with you before we started this because you kind of touched on it, but I can't express why I love sharing this enough. But can you just speak to just briefly about why American Savings has such a unique opportunity to compete specifically around their ability to earn a strong interest rate and make just an incredibly competitive product?
Yeah. So what's unique about our company is, for the last 70 years, literally since the beginning of the company, we have invested the majority of our assets in real estate loans, and that is our core competency. We have an entire subsidiary company that does that, and we're able to we're very good at it. We operate it profitably, consistently over ups and downs of the economy, and and because we have that ability, we earn a higher yield on average than if we were just to do what the traditional insurance company model is invest most of your assets in corporate bonds, and we're able to earn higher rates than that, and it actually is even better than that because we have this experience and this skill set that is kind of unique for most insurance companies.
Mhm.
There are a number of other insurance companies that say, hey, can we get in on this? I mean, you guys have something here that's really profitable and
Cool.
beneficial, and we don't have access to those. And so we've been able to actually grow our lending by having other insurance companies participate in those loans with us. We have about 20 insurance companies now that participate in loans with us. And that's allowed us to grow that. And now we earn income from that, right? We earn fees
Wow.
off of their money. So that helps the company be even more profitable doing what we do, which is lending. So yeah.
Yeah. It's interesting because you guys had, there's that brochure from Standard Analytics that shows all the solvency ratios, the profitability, the, surplus and everything. And it's crazy how you guys are so far ahead in each major category that you would judge the strength of an insurance company by. I mean, you guys are leaps and bounds ahead of some of the biggest name brand household companies that, I'm not going to say any names, but the big, the ones that you see on the commercials every 5 minutes. You guys have some really impressive financials. So that's something to be really proud of. That's just a testament to great leadership and culture and what you guys do really well, just focusing. So let me ask this question because everybody wants to know this too. If an insurance company puts together a lifetime income annuity and the client puts their money in and they start receiving payments and they get so much cash flow from it that the actual principal they put in runs out, how the heck can an insurance company guarantee to make all the rest of those payments if there's no more money from the client in the account? How does that, people don't seem to understand that concept. It just doesn't make
Sure.
sense.
And that's naturally understandable. If it was a segregated account where, okay, you give me $100,000 and I'm going to pay out, $1,000 a month for the rest of your life, or whatever that number might be, yes, that could happen. But the insurance company, in all insurance products, it's like this. You pool together all those accounts and those funds, and some are going to pay out in shorter number. They won't live as long, and we won't have to pay out as long, and some will live longer. But there's an actuarial calculated average life expectancy when that annuity is written. And
Mhm.
and based on that, and they always have a margin of error in there to give us a little bit of buffer in case that's off. But we use that, and the law of averages just says, hey, on average, this is how long you need to have. And then you calculate out, okay, if we invest it, earning this return over that lifetime, we'll have enough money to pay even for the ones that go longer, because we will have saved on some that go shorter, right? And so we take the risk away from the annuitant or the policyholder. They don't know, how much money do I need to have this income for the rest of my life? I might live 10 years, I might live 30 years, and we take that risk.
I want to get your feedback on this because I was having a conversation with a 25-year-old guy we hired last night, and he's doing some social media stuff for us and all this, and he's going, Daniel, just can you explain to me why would somebody buy an annuity? Like, what is an annuity? He's 25, right? So I said, okay, look, I said, Blaine, pretend that you're 25 years old and someone's going to write you a check for $1 million. You're not allowed to work the rest of your life, and your only job is to make sure that $1 million lasts you for however long you live. That's why people buy annuities, because they want that guarantee that they're going to have the cash flow and not have to manage it themselves and be worried about running out of money and be trapped in this scarcity game where they're just shrinking, 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 or making mistakes and having problems show up. They just want that certainty, right? And so when I told him that analogy, he got that, and I started thinking about, I was like, man, if you were in your 30s, let's say you got 700,000, right? And if you're in your 40s, let's say you got 600,000, right? And you kind of lower it as you get closer to life expectancy. That could kind of put someone in the shoes of how a senior could feel when they retire, and why lifetime income is so important. What are your thoughts on that?
Yeah, that's a really interesting um, perspective. Like, I hadn't thought of it from that angle before, but that makes a lot of sense, because the longer your life expectancy is, the more capital you need up front to keep it working for you. And remember, you do have the benefit of, so the insurance company has the benefit of having that money working, right? We will invest that money and we'll be earning interest on it as
Yeah.
we're paying it out. So, and as you know, portion of the payment it'll be recorded. It says this portion of your payment is taxable, is considered interest, and this portion is non-taxable. It's considered a refund of your principal.
Mm.
And so we're sharing that interest and principal over time. So that's another reason why if you gave me $100,000, when I've paid you $100,000, well, some of that was interest. So right, we still have some of that $100,000 working for us because we're paying you interest and
Right.
some principal.
That's great. Yeah, amazing kind of cool benefits you can do in terms of controlling when and how you pay your tax, I think is a huge benefit. My next question was about how a company can take one premium and then somebody were to, God forbid, die right away and then they pay out a huge death benefit. But I think you really explained that well with the risk pooling. It's really the same thing,
Yeah.
gathering that it's on the life side.
It's yeah, if I just maybe I restate it in a little different way, but the beauty of insurance
Mhm.
is it's risk pooling. Exactly. Fire insurance, same thing for your house.
Mhm.
You don't know if your house is going to burn, or your neighbor's house is going to burn, or whose is going to have this claim, right? So
Right.
y'all pay the insurance company and they take that risk. So you just know, I know I'd have to pay this, and car insurance, it's all the same.
Right.
Life insurance and lifetime annuities are really the same.
Yeah, in terms of the risk pooling. That's amazing. All right, last question. And this is what everybody always wants to know. What happens if a company fails? Like, can life insurance companies even go bankrupt?
So yeah, that's a great question. Actually, life insurance companies are specifically excluded from the bankruptcy code. So
Wow.
we cannot file bankruptcy. What happens if a life insurance company becomes what's called insolvent? So if we become unprofitable and we lose our surplus, our excess, where our assets actually become less or look like they're going to become less than the liabilities, than our obligations to our policyholders, then our regulator, the Department of Insurance, will actually um, have the court of the state appoint them as a receiver for the insurance company. So they legally now have responsibility and authority for the insurance company. And so that's called being put in receivership. While the insurance company is in receivership, the point of the insurance department being the receiver is they're going to try to protect the assets as much as they can to make sure that those policyholders are paid.
Hmm.
And they'll determine one of two things is going to happen. It's either going to be a, a liquidation of the company, where they sell it to another insurance company.
Hmm.
And if there's a shortage, then that is basically charged to the guarantee fund, that all insurance companies that are licensed in that state have to pay into every year. We're all assessed
Hmm.
and to participate in that. And that's what will make sure that the policyholders are made whole if there is an insufficiency, um, uh, up to certain limits, right?
Hmm.
There are limits. Each state is a little bit different. Um, or it could be that it is a rehabilitation, is what they're seeking after. If it looks like the insurance company, maybe it was a temporary problem. They just there could be reasons why maybe the insurance company is able to get additional capital invested. They just needed some time to do that. There could be reasons why they then rehabilitate the company, and the company can then emerge from receivership like a company would emerge from bankruptcy and be
Hmm.
back as a normal insurance company as they work through that. But yeah, so we have receivership, not bankruptcy.
Yeah, and I like how you started this when we were talking about this before the interview, and I was like, I asked you this question, you're like, Daniel, I'm not an expert in this. I have no experience in company failure. So I'm like, that's a great thing. You should mention that.
That's right.
It's a
That's true. I'm not an expert in it for sure.
Yeah,
That's
that's
the
wonderful. Byron, it's so great to see the leadership and that you stepping out and making time to connect with people and reaching out to clients and viewers and supporting everything. And I mean, you really definitely care about the agents and the clients, and it's just great to work with your company that everybody in that organization does. It's just the leadership there is incredible. So thanks for everything you guys do. I really appreciate having you on.
Well, thank you, Daniel. And by the way, I think it's awesome your channel that you're doing. You provide some really good information. I've watched quite a few of your videos over time. It's fun to. I'm subscribed. I'm one of your subscribers, so
Thank you. I
so
appreciate the support. I see a comment every once in a while, and I'm like, I'll be at like night, I'll be
it's
like,
good.
oh yeah, I
It is
appreciate that.
great. So
I
I
appreciate
appreciate
it.
the opportunity, buddy.
Yeah,
Talk to
my
you.
pleasure. Thanks for coming on. And if you like this video and you didn't see our first interview, I highly encourage you to go back, check it out. We'll post it right here. You can click on it and watch a whole breakdown of American Savings Life Insurance Company, their history, and all their principles and everything they've done to be so successful. So thanks again for watching. We'll see you soon.